Taking a look at Treasury yields, the 10-year at 4.42% this morning, the 2-year at 3.9. Joining us now, Priya Misra, the fixed income portfolio manager at JPMorgan Asset Management. Priya, great to have you with us.
Thanks for having me.
What are we seeing priced into Treasuries right now? Have we seen the effects of the tax bill? Have we seen the assumption that the Fed is going to cut rates? So, I mean, what are we looking at?
I love that question because there's so many cross currents with interest rates. So to answer your question, I think the fiscal side, yes, we've known about the one big beautiful bill for a while. I would say it's largely priced in. We also know that we're getting tariff revenues, and the total cost, you know, the total amount that we can get from the tariff revenues, the CBO is projected 2.8 trillion versus the one big beautiful bill cost of about 3.2 trillion. So actually they almost kind of offset each other. You look at the yield curve has steepened. So the market is pricing in that we have an unsustainable deficit trajectory. The deficit is a lot. And so I think that curve has steepened. We're pricing in fiscal. On tariff, I think the market has a little bit of tariff headline fatigue. And I think if you look at the underlying economy, the economy is slowing, but we're in subtrend. We're not talking about recession. A lot of those tail risks have been taken off. Inflation, the big concern around tariffs was this is a stagflationary shock. Inflation's actually come in weaker the last few months. So I think that's why that front end of the curve is still pricing in Fed rate cuts. It is pricing in a soft landing. We're only talking about 100 basis points, 120 basis points of cuts, which is the market saying, look, inflation may be a one-time price shock because of tariffs. The economy is slowing. The Fed's going to do those good news rate cuts. And I think that's how you can square where the Treasury market is versus where sort of risk assets are.
In terms of a one-time price increase, a price hit on tariffs, is there an assumption that tariffs will be removed, or are we assuming that there's going to be some base level of tariffs permanently and that is priced in?
I think the market is pricing in some base level. What that level is an open question. I think 10% on the world and maybe 30% on China or transshipment. I think that might be baked in. To the one-time price shock, I think the U.S. is still a service economy. 75% of the consumption basket is services. So we're looking at service inflation, whether it's housing, ex-housing services. That's actually coming down closer to the Fed target. On the good side, if you pay that one-time 10%, and then where in the value chain is that absorbed? We do think corporate margins is going to absorb some of it. The consumer is not strong enough for companies to pass on the entire price increase. So there's some element of that. And then if it's not that tariffs will get removed, I do hope tariff uncertainty reduces. I mean, I think we're hearing a lot of the sectoral tariffs. So that's my risk factor for that one-time shock. What if you get the one-time shock because of the 10% baseline, and then you get the sectoral tariffs, and so you get this a few humps along the way or bumps along the way in inflation? I think that is the risk scenario. That's what the Fed is contending with, which is why they seem to be in this wait and see. So I think that's still a risk factor. But yeah, I think some baseline tariffs is in the market.
In the copper, the 50% tariff on copper potentially seems like that could be a big hump because it feeds into so many industries, and that is much greater than what the markets have been pricing in terms of a tariff.
Right. I was a little surprised that the market yesterday took that 50% or the 200% exactly. Risk assets took it well. I think even Treasuries took it well. I think there's a hope there that this is a negotiating deal, tactic by the president. It's a maximalist. Let's escalate to de-escalate. I don't think 50%, especially downstream, because when you get the input costs going up that much, and we saw it with steel and aluminum in 2017-18, I think the market is assuming that that's where we start, but we're going to end up at a much lower level.
Speaking of taking it in stride, the bond volatility index, I mean, that's pretty low. I mean, traders are pretty complacent. I mean, not just on the bond side, on the equity side as well. Where do you see the 10-year ultimately, in 6 months to a year?
So in a soft landing, our base case is that we stay in the soft landing environment, which is growth in the 1 to 1.5% rate. Inflation a little higher than here, but not as high as it was in 2022. 4 to 4.5 seems like a very fair place.
So we're right in there.
And that's right there. I think as you get closer to that 4.5, we're going to say that owning a little bit of duration here makes sense. But if you think about overall high-quality fixed income, you're getting 6.5. If you go into high-quality high yield, you're getting 7%. That's why people like fixed income, because given all the volatility, if the Fed's not going to hike, if interest rates don't really cross 4.5, that's a lot of income, and you get that diversification benefit. If the economy does slow down, and then the Fed will have to cut a lot more than is priced in. And I think that's why fixed income does look attractive.